if you initiate the trade with a probability of 80 plus percent, and you're going to get out once you're up 50% or 55%. So that's going to increase this probability. You're going to most likely have a probability of 85 to 90% if you're getting out at 50%. In this video, we're going to discuss how you can short-term trade at night using the ES options.
Please subscribe to our channel. Happy trading! Manage your risk.
Now, you've probably heard of short-term trading using the SPX cash settled options. That's super popular right now. We use a bunch of different videos on YouTube about trading 0 DTE options. DTE means days to expiration, 1 DTE, 7 DTE. You can see a lot of videos that we have created on the process of using SPX. But at the Dorian Way, we also trade, and probably more than we trade the SPX, we trade the ES. The ES is the S&P 500 futures contract that has options attached to it. So we trade options on a daily basis using the ES options. And you can trade it on a short time frame, you can trade it on a mid time frame, you can trade it on a long time frame. And so if you work a full-time job, then you can use the ES to still trade short term and make a significant amount of money. So if you trade anything like a 1 DTE or longer, you can use the ES options. We don't recommend you doing it as short as 1 days to expiration or 1 DTE, because you're not going to be able to manage that the next day before it expires if you're working a full-time job, you work during the day. So we encourage you to strongly consider the 7 DTE options, because you can take what we believe at the Dorian Way, you can take $5,000 and you can make 2% off that money consistently week after week using just $5,000. Obviously, if you have $10,000 or $15,000 or $20,000 or $100,000, you can make more. But the framework is using $5,000 for every 1 contract. And so if you work a full-time job, the ES trades at night. It trades almost every night, Sunday night through the end of trading on Friday. The only day that the ES is not trading is on a Saturday. So if you put on a trade that's 7 days out, that's going to give you time to be able to check that trade at night when you get home from work and be able to adjust it or take profits or whatever the case may be. You will be able to do that at night. And we have a number of different members of the Dorian Way trading this exact strategy, what we call a 7 DTE short-term trading process, using $5,000 per every contract that they trade, so that they can have enough cash to be able to adjust the trade if they need to. So we've talked about in previous videos that if you're trading the SPX on a 0 or 1 or 7 day time frame, that you need to understand how to adjust. You need to know what is called, what is a roll up, what is a roll away that we coined at the Dorian Way, what is a roll out. You need to understand those adjustments to be able to trade short-term trades successfully. Even if you're using a stop loss like that we teach in our statistical day trading course that Dr. Meadows has created, we'll have a link to that in the description area. You're still going to have to understand how to adjust, because he's coming back in when he gets stopped out. He explains how do you come back in so you can still have a good chance of winning even though you got stopped out. And so options, when you short-term or day trading options, it's not a 50-50 shot. You can have greater probabilities, and that's why trading options are so powerful. It's not just like trading a futures contract or stock. It's not a 50-50 shot. The short-term trading is not a 50-50 shot. So let's go over the process of how you would set up the trade using the ES options. So I have this option chain set up here that has 8 days to expiration. You can do 8 days, you can do up to 14 days. What we believe at the Dorian Way is that anything between 0 and 14 days is a short-term trade. But we're primarily doing 0 DTE, 1 DTE, and 7 DTE. So in this example, we're recording this video on a Sunday, so it's 8 days expiration. This is going to expire the following Friday, but it's still the same concept how you would set it up. So what we're normally doing is that we're going to try to be no higher than a 10 delta, and we're going to do a 20-point wide spread. So and we're doing an iron condor. So on this call side here, we're selling the 46.90 10 delta, buying the 47.10, and that's creating a 20-point wide spread. Okay? When you're trading the ES, each point is $50. It's not 100 like it is with options on stock. Options on stock, the denominator per point is is unified or standard. It's always $100. When you're trading options on futures, it differs. But the ES is the most popular futures option. So you want to know that it's $50. It's half the price of the SPX. It's $50 per point. So in this example, you would have $50 times 20. So your max loss before the credit you receive on this call side here is $1,000. It's $1,000. When you're doing an iron condor, you're selling a call spread and a put spread simultaneously. So in this example here, we're going to also go down to basically a 10 delta. This is saying a 9 here, and we're going to do a 20-point wide. Keep in mind, we're only going to use $5,000 per contract. So if you were trading this, your max loss is 1,000 minus the credit you receive. So we're receiving 130. The number down here is going to say 260, but you divide that by 2 because it's only $50 per contract per point, as we indicated before. So you have 130 and your max loss is 1,000. So you take the 1,000 minus the 130 and you get 870. You get 870. That is your potential max loss, is 870. When you're trading options on futures, they use span margin. So it's based on your portfolio and how much buying power you're going to use. So in this account, this demonstration account that we use at the Dorian Way, we have a number of different things on in the ES. So it's not requiring very much buying power. But you can't expect this if this is the only trade you are doing, or if you don't have a lot of things on. So your buying power might be 500, might be 700. Most likely it's going to be close to $1,000. It's going to be close to $1,000 because when you're using span margin, as you get closer to expiration, they actually could require a little bit more than your max loss. I know that sounds weird, but that's how it works. If you're doing something 30 plus days out, they're going to require a very, very small amount based on your max loss. So if your max loss is 1,000, they might require only 200. They're not going to require 1,000 like they would on regular options, like they would on the SPX. So you have to understand that even though your buying power on a short-term trade might be significantly less than your max loss, you have to base it on your max loss when you're doing these short-term trades. Even though you shouldn't have a max loss, you should never have a max loss with these type of trades. So we put it on, and I just say we got at least an 80% chance of winning because we put it on no higher than a 10 delta on both sides. We're collecting more than $100, and so if we get out of this trade with $50, if we receive just 100 and we get out at 50%, so that means we receive $50. Well, we're making at least 1% off our 5,000 in 7 days. Okay? So if you initiate the trade with a probability of 80+%, and you're going to get out once you're up 50% or 55%. So that's going to increase this probability. You're going to most likely have a probability of 85 to 90% if you're getting out at 50%. But you're going to have to know how to adjust these. You're going to have to know how to do a roll up. You're going to have to know how to do a roll away. You're going to have to know how to do a roll out to be able to fight the market when it goes against you, because you do have risks on both sides. When you're doing an iron condor, you can't lose on both sides, but you do have directional risk to both sides. When you're doing an iron condor, you are inherently neutral. You want it to stay in between your short strikes that you sell. And if it does that, that's how you can win. But most of the time, the market's going to make some type of push up or down. And if that push is big, then it's going to cause a problem. And if that push is not big, you're going to win without any issues. And that's going to happen a lot of times. That's probably going to happen most of the time. But that 30% of the time, or that 32% of the time that you have issues, then you're going to want to know how to adjust. We teach you that at the Dorian Way. Okay? All right. So if you like this video and you want to learn more, please check out some of our other videos on this topic and leave us a comment, good or bad, in the comment area. And please subscribe, support us. We're trying to grow to at least 5,000 subscribers within the next 3 months. And if we can do that, that'll be awesome. So thank you for your support, and we'll see you in the next video.